have a veteran investor and stock picker, Kenneth Andrade of Old Bridge Capital, who's joining us today on the show. Kenneth, afternoon. Thank you so much for your time. As we wind up 2023 and look into 2024, a big change has been the investor expectations of returns from the market. The way the recency bias actually kicks in, right? Past 2-3 quarters have been very hefty returns if you are more tilted towards mid cap, small cap. How should the behavior angle be next few months and quarters, given the light of how the market has behaved?
Well, it's an interesting question, and because if you just step back as early as March of 2023, which is this calendar year itself, and exactly the reverse was actually happening, right? Markets were not doing well. Number of companies hitting 52-week lows were close to about 700. And today the reverse is happening again. Number of companies hitting 52-week highs and all-time highs are significantly higher. So you've kind of upfronted a lot of your returns, or prices have upfronted a lot of their future returns right now. And now it is left for corporates to really execute to justify some of the pricing that is there. So it's at any stage in time, especially at this point in time, you have to relook at your portfolio and look at what risks are associated with those businesses, because not all small businesses need to be given a price earning multiple, which is what the market is doing at this point in time. So you have to be a little cautious as we go into 2024. This exuberance could continue for a while, but I think I leave enough on the table for the next person to actually get there. What you also need to be contentious and conscious about is try and navigate a portfolio your current portfolio towards more sustainable long-term trends, which could be volatile near term, but you should have enough of conviction to double down on your position if things go wrong. Okay, so behaviorally, that's what most investors are apprehensive of doing. They sell when it's low and they buy when it's high. So you have to let go of the momentum or participate of the or either you participate with the momentum, but double down on your position and find the conviction to do that. I think that's how I would approach 2024 going forward.
Interesting take, Kenneth. But given you are flagging out a bit of a caution and you're saying it's a good time to probably relook at your portfolio, what do you think is the best tactical call right now? Are you saying go a bit low on equities, perhaps sit on a bit of a cash, or look at other investment opportunities as well, whether debt, bond, real estate, and even gold for that matter?
So, I mean, the fixed income market and debt, even in the fixed deposit market, is fairly lucrative even today. And most investors actually put money into fixed income in March of 2023 and sold equity. And the yields were not as good as today it is. Okay, and today we've actually overlooked the yields to put money into equities because historical returns look good. So I'd rather balance out the portfolio, but let me put it this way: as an equity investor, my view on cash is fairly simple. I can have 15% cash, or I can have 20% cash. That's good, but I still have equity, 80%, which is equity, which will also go through that volatility. So it's like 80% that I need to I need to relook at all points in time. But even on the cash bit, I think the markets are fairly broad, fairly wide. You necessarily need to pick a sustainable trend in the marketplace and allocate capital out there. Now, whether it's fixed income, I'm not too sure about the other asset classes because that hasn't been my domain. But in equities, I think you should have to give it a pause, let your portfolio consolidate, and then relook at performance on some of the companies in your portfolio during 2024. But at this point in time, just navigate the volatility that we might see some of it coming through in 2024.
Okay, point taken. So let's discuss that 80% of the portfolio which you do want to put in equities right now. Which are the spaces which still look comfortable? Because valuation-wise, it seems a lot has run up already. Do you find more value within the large cap category now? And in 2024, one should expect that large caps might outpace the mid cap and small caps?
There's obviously a significant valuation gap that exists between some of the small mid markets and the large companies. So it's quite a no-brainer as to where you should be at this point in time, right? And that's how you need to necessarily allocate. Also, if you're doing a fresh allocation. Um, so you got that right. 2024 valuation advantages are with the big caps, but it's not to say that the big caps are significantly cheap. The market as a whole has traded up and is hitting all-time highs, and you need to be cautious across the entire board.
Kenneth, I see some of
So
your names, some very interesting pharma exporting names, which have good injectables play, API play embedded in them, which haven't really done very well in the last 2-3 years. But it appears that things are turning around. If I were to go by the last posted results by some of these names, so do you think that this is sustainable and there is indeed a big turnaround happening in that zone, large cap pharma zone?
So if you look at the pharmaceutical business from our lens, from a lens of from us as an investor, right? We tend to believe that a company that is there in our portfolio will make money if the industry profitability increases as a whole. So for any business in a particular industry to do well, the industry profitability has to be large, and that's how we tend to play this cycle. So our sense on pharmaceuticals has been it was going through a downtrend right into 2020 and 21. And that was an interesting phase in time because a lot of these companies or some of these companies came back to historical lows in terms of valuations. Now they're nowhere close to historical high in terms of valuations, but now they also have an element which you mentioned of growth that is sitting there. And if that's true, and all of this plays out over the next couple of years, I think it's one of our most favorable sectors that we are participating in. And it's not just pharmaceuticals to look at. I think it's the entire chemical chain that is there. Chemicals as an industry came off its all-time high. And they've been trending lower because there's been reasonable amount of concerns on growth, on pricing, on margins, and how this industry trends forward. But when there's enough of concerns at that broad spectrum, there's also opportunity because prices are lower. Okay, stock prices are lower, and that's what we like. We like uncertainty in an environment because then price is in your favor. So that's stepping back to the broader question on how to look forward to 2024 as a whole. Look for a decline in price because then price comes in your favor, and that's when you can allocate with a very high margin of safety.
Oh, well, yes, margin of safety, that's the, base rule that everybody has been teaching us with respect to investing. So comes back to that. But Kenneth, are there any other further niche areas where you still see some amount of investing opportunities and ideas cropping up in the markets right now, whether PSUs, defense, industrials, real estate, anything that catches attention?
Look, we've come through a transition since 2020, and we've seen the market to its all-time high. Now, if I look at a simple parameter of market capitalization to GDP, NSE 500 is almost at its peak. To say that the market is going to give you extraordinary returns, I think it's going to be wrong. To say it's going to give extraordinary returns, can it give you sustainable returns? I think there are plenty of opportunities that are sitting out there. Now, here's where it comes in. A lot of companies out there are great companies, but not all great companies become very good stocks, right? Because when you buy a good company at a good price, it becomes a good stock. Now, in the marketplace, what's lacking right now is the latter, right? The pricing is just not right in a lot of spaces. But if I dwell down a little bit and look at the non-participants, and probably the best way to look at stocks in the environment right now is that look for companies that have 52-week lows of all time or the last 2-3 years lows, and if they are large in their industry, that's the place to go to. Okay, so some of the pharma names, some of the chemical names, we find a company in logistics or two doing reasonably well. We find some of the discretionary spend names. They're not very cheap in terms of valuations, but I think on every corrective they make that they become very interesting to keep adding value, adding your position to. And of course, the our favorite has been, for some time has been commodities, so it hasn't done too well. I think both in terms of where the balance sheet construct of these companies are, they're paying back debt quite rapidly. Their cash flows are close to their all-time high, and their expansions are all hitting meaningful size in 2024 into 2027. So you get volume growth coming in, you got valuations in your favor, and you got margins also which are fairly sustainable given where the historical trend has been. So if you step back a little bit and not look at the momentum of the market, I think you'll find enough of opportunities in all of these names.
Scratch that point on metals a little further, but let me go back to your point on chemicals. Kenneth, I remember speaking with you on this when last time around, a few years back, the chemical cycle was in full bloom. Right now, it appears that it is at the peak of pessimism. Which side of chemicals are you witnessing good risk reward and highest margin of safety? Is it the specialty ones, the India focused agro ones, or some other specific basic chemicals ones? How do you approach chemicals?
No, it's a large spectrum of businesses that are sitting out there, but I like companies, or we like companies who got a global footprint. So we start with the business which has got a B2C basically, which has got a B2C footprint rather than a B2B footprint, and then wait for the B2C to deliver, and then move down to companies that are B2B. Look, for any industry, you got to get pricing right. Once you get pricing right, okay, that's when the entire value chain starts doing well. So the consumer has to pay, inventories have to go off the shelf. We wait for those two opportunities come through, and if the company that you hold is getting market share, that's all that you want. So let's start with any of these three. Today in chemicals, look for a B2C play, which is significantly large in terms of global footprint. Look at the industry. Industry is saddled with inventory. Pricing is just not there. Okay, it's a matter of 1 year, 18 months, or maybe 24 months that all of these parameters will start changing. And when these parameters start changing and the business that you hold is got pricing power, then you can actually build the entire stream backwards to B2B businesses or commodity chemicals. And I think over the next 6 months to a year, you will even get value very much in your favor. Not back to historical lows. I don't think they'll ever go to historical lows because they came from a time where most of these companies were trading at insolvency valuations. So I think that's how we move with it. And the names are fairly simple. Look at any of these companies which are going back to 2 year or trading close to 2 year lows or close to the 52-week lows. Those names will all come up on your screeners.
We've talked about metals, pharma, chemicals, but I also wanted your take regarding consumption, because one of the big trends of this year has been premiumization and the rise of affluent India. What exactly is the best way to play that? I mean, are you looking at auto ancillaries? Are you looking at some of those niche names like, a luxury car retailer, Alcobev? Which are the ways to play it?
Okay, there are multiple ways to do it, and what you're seeing right now is it's playing through the real estate cycle, right? Okay, and the real estate business is the biggest part of anyone's balance sheet, or probably the biggest part of anyone's income statement if you're taking a house on rentals. And I think that's how the market's actually played out. Not to say that any of these guys are priced cheaply, right? We've seen some of these real estate companies do extremely well, including a lot of these discretionary spend businesses that are there. But like I mentioned in context, the profitability of the entire segment has to grow up, and then everyone participates. We can all have a different choice of these businesses. Some will like luxury watches, some will like luxury jewelry, some will like real estate. I think all of this will participate, but the conclusive proof, like you did mention, is that you've got to focus on urban India. I mean, even if 20% of India's population has wage inflation, which is higher than inflation itself, that's the population of probably the US. So we've got a very large urban population, which is which has got wage inflation, which is inflationary, and there's an opportunity to create create a portfolio around that. You got to be a little careful because valuations are nowhere in the comfort zone at this point in time.
Kenneth, let's come back on metals or global commodities. Keeping oil aside, I want to understand metals in particular. Which end of the basket do you see? I get your point. Indian metal conglomerates, be it aluminum, steel, everybody was debt laden, and now last few years are consciously reducing debt. Volumes are okay, but what about pricing? Would the global pricing, because of US and China remaining anemic on growth, pricing would be on the lower side?
So the interesting part of the marketplace today in commodities is that everyone is looking at pricing to come through for supernormal growth, right? Look at profitability that will come through for supernormal growth. Look at volumes to come through for supernormal growth. Simply put, if any commodity company is increasing capacity by about 10% to 20% a year, okay, increasing capacity by 10% to 20% a year, using internal accruals. So you have two things moving: your balance sheet remaining static and volumes increasing, which is your return on incremental capital is actually moving up because of volumes. Right, and all companies, because of that super cycle that you had in commodities, have been able to manage their balance sheets very well. So I not look at commodity prices to drive profitability. I just look at increase in volumes to actually drive it all. And you can have it with soft commodities. I mean, you'll have we've all seen what happened with soft commodity processors in India. You will have it with metals. You will have it with chemicals. You'll have it with the entire chain. You just have to look at it from that perspective. Remember, this time increased. I mean, what found favor in the last cycle is not going to find favor in this cycle. In the last cycle, it was low capital investment and high profitability. This is capital investment which will drive profitability that will happen in this decade.
Kenneth, point taken. Before I let you go, I want to squeeze in one more question, despite what my producers and directors are telling me. Kenneth, if you had to pick one theme for the next 3 years, energy transition, manufacturing, or any other, what is that one theme you will bet on, or even urban consumption for that matter?
I think we've been consistent in saying that this is going to be an inflationary decade. Okay, and if this is going to be an inflationary decade, it helps only to it helps basically just two stakeholders in that. One is corporate profitability, which will be high. Pricing will continue to move up, and second is governments will inflate their debt away. And these are the two stakeholders that you need to watch for. If government's balance sheets are going to get better, they're going to become the biggest spenders. And if they're going to be the biggest spenders, it's going to be a B2B market or a B2G market that will do consistently well through the decade. And this is something that is going to happen globally. Any business facing the government is going to do extremely well, and any business which is there, which is a B2B cycle, is going to be is doing very well. And because it's inflationary, we think the bottom end of the consumption cycle would continue to struggle.
Okay, Kenneth, we would have loved to chat more, and I don't think we would have stopped chatting even for an hour, but we have to acknowledge the time at hand. Thanks so much for making time and speaking with us. Really a pleasure listening into you. But with that